From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go. Quick ask, if you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much. All right, so assuming you were listening on the day this podcast drops, it is Wednesday and the Fed either is going to or has just cut interest rates. So what the heck does cutting interest rates actually mean? I think most folks think that cutting interest rates means lower mortgage rates, and I think our folks in Washington have led people to believe that, but that's actually not the case at all. So on this podcast, what we're going to do is address what it is the Fed looks at and who specifically is impacted when the Fed cuts rates. So Brett, when it comes to what the Fed is looking at when their decision-making process of cutting interest rates or not comes down to a dual mandate. What is that dual mandate?
Absolutely. Setting the stage here. So the Federal Reserve has a very clear and defined dual mandate of stable prices and maximizing employment. So they try to run stable prices around 2% inflation per year, and then they try to essentially make an active decision real time as to what full employment is. But generally speaking, they've been able to run full employment, around 4 to 6% annualized. So I'll toss it back to you, though.
Yeah, so stable prices, let's just get some context as to where we are right now. So we come from a backdrop of just seeing nasty inflation, some of the nastiest inflation we saw since the 1980s. In 2022, on the backs of COVID, then stimulus checks, PPP loans, and a Russian invasion of the Ukraine, inflation absolutely ripped. And it hit 9.1% at its peak in 2022. And the Fed yanked interest rates higher very, very quickly in order to track that down. And they effectively were able to bring it down to a modest rate in the twos, right? But what we've seen over the past year is inflation starting to eke back up again. So we've actually now seen 5 straight months where inflation, CPI, Consumer Price Index, has ticked higher for 5 straight months and has now hit 3%. So that becomes a number that's getting further and further away from that 2% target and is making it a little less comfortable to say, yeah, we can continue to cut interest rates. But I think that then dovetails with the other side of the equation, with the full employment. And Brett did give you the context that full employment's been 4 to 6% historically. Our average unemployment rate in the United States over the past 50 years has been 5.7%. Right now, we're at 4.4%. Right, so that actually looks pretty darn healthy from a full employment perspective. But I think it's really the rate of change, just like the rate of change in inflation moving higher, that has the Fed angst, right? And so what you have now is 3 straight months of unemployment ticking higher. So now when you look at the Fed's dual mandate, you have inflation increasing. So that says don't cut interest rates. In fact, is raising on the table, which that's not, let's be clear. But the other side of the equation says employment is starting to weaken some, and that says cut interest rates. And so now they're at this kind of point of contention as to what the heck is it they do. And right now, today, in all likelihood, when you've heard this, they've already cut interest rates. So Brett, add some context on the back end on your end as to how you think about this, because this is really a sticky situation from the Fed. They've got this blunt instrument of interest rates to determine whether they raise, they lower, as they try to maintain this dual mandate.
Yeah, so I think, one, there are things that we see in the market that are signaling very clearly that stagflation, which is a scary word, or a mild stagflation is on the table. And you don't have to look any further than gold prices, right? Everybody follows gold prices, everybody in the markets, and then even a lot of retail investors. I mean, look at Costco. Costco sold more gold than probably anything else they've sold out of their stores recently. And all that's hinting at is the consumer can feel the stagflation, right? They can feel the inflation in their pockets. And then obviously Wall Street, if you will, which is the quote unquote smart money, is piling into gold as well. And the central banks globally are piling into gold. So one of the asset classes, you go back and you study the characteristics of when asset classes perform, gold has historically performed during stagflation. So that's a pretty good indication there that, the market's at least hinting that potentially stagflation is on the horizon. And that's what puts the Fed kind of in a box, right? And back to, a comment Taylor made earlier, when people are out there, thinking about the economy softening, and if you actually dug into those unemployment numbers and saw where the layoffs were happening, they were happening almost exclusively at small businesses. You get the headline news where Meta may lay some people off or some things like that. That tends to be in a growth channel to where they're looking to develop further. But where the layoffs have primarily been happening throughout the United States over the last several months and quarters have been in smaller companies, right? So when we talk about the K-shaped economy, it's not just the wealth distribution from families that are making less money up to the top of the K-shaped economy where you have wealthy families, but it's also businesses, right? You have the big businesses like the Mag 7 on the top of the K-shape, and then you have smaller corporations on the bottom, and they're obviously feeling a lot of the pressure. Right now, it looks as though the Fed's going to cut 25 basis points. That's priced into the markets at this point. So if it doesn't happen, that will upset the market, meaningfully.
No doubt about it.
And one thing that the Federal Reserve has been very, very good about recently is they will talk to the market in one way or another through their different, through the regional presidents, if you will, to essentially let the cat out of the bag early, right? And if they essentially test the waters by letting some news release, if the market takes it okay, then they'll proceed down that path if that is their motive. And then if the market doesn't take it well, they'll look to dial it back in and maybe have a different Federal Reserve president come out and speak on the topic to essentially cover it back up. But pretty wild to say the least. So what we have going on is lower interest rates, likely in the future, just a little bit lower on the front end. But Taylor, let's jump over and talk about what part of the economy short-term borrowing, right, the Fed funds rate, actually materially impacts.
Yeah. So I think there's lots of different areas of the economy. And you think about interest rates and you think about lowering interest rates, think about it just providing lubrication to the gears of the economy to continue to cycle. So some of the easy ones right off the top to focus on, Brett talked about the K-shaped economy. The folks on the lower end of the K-shaped economy have been increasingly taking on credit card debt to finance their life as the cost of things have materially gone higher with inflation over the past 10 years. And so with that, credit cards are directly linked to the federal funds rate. So when the federal funds rate gets cut, if credit card debt floats downward, so the interest rate comes in along with that. So it provides a little reprieve for folks that are paying 25% interest rate on credit cards. Now, it's still going to be incredibly high, and you certainly don't want to handle and hold credit card debt if you don't have to, but it will incrementally bring that credit card debt down. And so that creates a little less burden on those that really need it, especially this time of year as people look to rack up bills as they go into the holiday season. So credit card debt helps the lower end of the K-shaped economy. The second one, Brett, you've already alluded to this, and that's the fact that small businesses really get helped by this. So what we've seen over the past 5 years, 10 years even, is that large companies have really outperformed small cap companies. And that's not typically over the long term what's been experienced in the market. But if you think about the large companies that have so meaningfully outperformed the Magnificent Sevens of the world, what they have are huge cash piles. So in effect, when interest rates got yanked higher by the Fed, it drove borrowing costs for small companies materially higher. And the small company couldn't afford to go to their local bank to take out a loan at 9, 10, 11, 12% interest rates to build out that new factory or bring on that new hire. But who could afford to do that and continue to expand their business and take over market share? The Mag 7, right? They have all the cash on hand. They don't have to borrow. So Brett, is that how you see it as well? Is that one of the main drivers as to why Magnificent Seven companies have gotten so big and their moat just seemingly got wider and wider as they could afford to finance business through their own cash flow?
Heck yeah. Heck yeah. I think on this channel, we've talked before about private credit, right? You talk about private credit or bank loans. Essentially, smaller companies issue debt in a floating rate nature, like an adjustable rate mortgage, if you think about it that way, which is different than what you'll get from a big company like a Walmart or an Apple or, pick your other Microsoft, somebody like that, where they can actually issue your traditional type of bond through the traditional financial channels. So at Walmart, when rates were super low a few years ago, you had the big companies, right? The large cap US companies, you had them issue 10, 15, 20, 30-year corporate bonds. They were smart, just like retail investors were, and mom and pops across the United States. They went and locked in 30-year mortgages when rates were really low. So these companies did the same exact thing. But small cap companies and private companies, they typically cannot do this because they can't issue bonds through the traditional channels. And bonds have obviously that fixed maturity and that fixed interest rate, just like a 30-year fixed mortgage. They're forced into a loan situation. So whether they're issuing, they could be a software company or, commercial real estate company or any other type of company, generally speaking, they're forced to issue floating rate debt, right? Which is a loan. So if interest rates are very high, like they were they're even still high today, obviously, at 3.8%. But when they were 5%, you got to think about that's the base rate, right? We refer to that floating rate piece that the Federal Reserve controls as the base rate. Then they also have to put their credit rate on top of that as well, their credit risk. So say there's 5% or 500 basis points of credit risk on top of the base rate. You got to think about these small cap companies are issuing debt at about 10% per year. Incredibly expensive. Look at the competition. Microsoft and Apple termed out their debt at 2.5% per year out 30 years, maybe 3.5, whatever it is. It was like cheating, right? So not to mention the amount of cash that the Mag 7 and the large companies are making. They actually, you would argue, don't mind these high rates because it actually chokes off the competition. The innovation, which typically comes from the small caps, allows the small caps that are essentially, 1 foot in the grave to be acquired for pennies on the dollar by the big dogs, if you will. And that essentially right there is describing the K-shaped economy. Real quick, Taylor, before we jump to the next bit of it here, there's one other party that very much so benefits from lower interest rates, and that is the U.S. government, right? So Scott Bessent is following in the footsteps of Janet Yellen, where what they're doing right now is they're issuing T-bills, right? So the U.S. government historically has issued a fairly balanced amount of T-bills, which are 1 year and under debt. Let's call it 5-year bonds, 10-year bonds, 15-year bonds, 20-year bonds, and even some 30-year bonds. They, generally speaking, throughout the last several decades, have issued a relatively even distribution of debt throughout the curve. What they are not doing right now, because of the shape of the yield curve, is they're not issuing 15, 20, 30-year debt because the yields on those on 30-year U.S. Treasuries right now is very high, right? You're pushing up on close to 5%. So what they can do instead is they can issue debt as in the form of a T-bill. And right now the T-bill yields are exactly what we're talking about and likely to go down 25 basis points. So you're at around 3.8%. Essentially cut at 25 basis points, which is forecasted to happen in the market right now, you're going to go down to 3.5. And that's where you have Trump and Scott Bessent and their team pounding the table to lower interest rates as well. They're saying, why in the world would we be essentially, keeping rates as high as we are? It's costing the U.S. government. It's also costing small companies and retail folks, mom and pops throughout the country. So that is one side of it, and that obviously is very well received on the political front. But there are other aspects of this too that, it can't play out that way forever. So Taylor, one of the things that I know we wanted to touch on was commercial real estate, which also, spills over into other parts of the real estate market. So I'll toss it back to you on the real estate side.
Yeah. So let's talk about commercial real estate real quick, because that's been a dog with fleas, for lack of a better way of putting it, over the past 4 and 5 years. And I think there's a couple things that played into that. One of them being very interest rate sensitive, right? So when you think about the fact that COVID hits, everyone goes home, office space goes vacant, and then COVID goes away and not as many people go back to the office. So COVID certainly caused some downward pressure, specifically in the office portion of the commercial real estate front. But compounding that problem in the broader commercial real estate front was the fact that they're very, very interest rate sensitive. So Brett talked about small companies having floating rate debt. Commercial real estate is not residential 30-year mortgages. They reset every 3 to 5 years. So when interest rates went from, in 2020, bargain basement 0 to all of a sudden getting yanked higher, and then what happens is that rate that commercial real estate buyer is paying on their mortgage goes up 5%. And then all of a sudden what it does is just whittle away at that free cash flow that was being generated, which was the difference between their really low mortgage rate and what they were earning on that property. Those two come into line and oftentimes even flip upside down. And then you see fire sale type proposition. And that's when you've seen such light exposure and light returns on commercial real estate when every other asset class has seemingly ripped. Commercial real estate is certainly in the crosshairs there of interest rate sensitivity. And I think that Brett mentioned here a minute ago kind of the strength of Trump and Besant's hand to try to force lower interest rates. And lower interest rates causes the debt financing of the U.S. government to be lower and lower. And I will give credit where credit's due. Trump did an amazing job 5-6 years ago during COVID and the nasty part of it, trying to convince the U.S. government to issue 100-year debt. Because at that point, interest rates were super low, and it would have been incredibly intelligent to focus on that 100-year debt and issuing it out at 2%. 100 years of debt at 2%, that's free money, and that's what we could have done at that time. But he wasn't able to convince, I guess it was Janet Yellen at that time as Treasury Secretary, that was the right decision to do. But I don't think it's all forthright coming out of Washington. I don't think what they're saying is all fair when it comes to interest rates. So let me kind of frame it up this way. Lower interest rates certainly should stimulate the economy. It allows businesses to borrow money more cheaply. It allows individuals to take out debt more cheaply and go out and spend that money. Now, what's the risk to that is that our inflationary issue that's ticking higher right now gets more out of control, and we'll talk about that in a little bit as well. But I think the other side of it that is being screamed from the mountaintops is by Trump and by Besant is that home affordability in the United States is a real problem. And there's no doubt that that is absolutely the case. It's the least affordable it's been in U.S. history. But what they're saying or what they're alluding to, and I think they're overtly saying, is that lower interest rates by the Fed is going to reduce mortgage rates. And I want to be 100% clear, and I'll walk you through this, that is just not factual. And I'll give you the proof statement to start with, and then I'll give you the actual underlying how the fundamentals work for mortgage rates. So the proof statement is, we just saw this happen. Last year, in September, the Federal Reserve started cutting interest rates, and they cut 3 times between September and the end of the year. Mortgage rates, starting in September on the 30-year, the average mortgage rate was 6%. By the end of the year, it was 7%. So very clearly there, the Fed does not control interest rate, or they control interest rates. They do not control mortgage rates. So let's break down and just educate a little bit on how mortgage rates are set. The Federal Reserve, as Brett alluded to before, controls very short-term debt. So think about things out to about 2 years. Now, mortgage rates, on the other hand, are dependent upon the 10-year Treasury rate. How banks set mortgages is they take the 10-year Treasury rate and they apply a spread on top that's associated with the individual's credit risk. So the 10-year Treasury rate right now is at about 4.1%. The historic average spread on average for consumers on top of the 10-year Treasury rate to get to your 30-year mortgage rate is 1.8%. Right now, it's about 2%. So 10-year Treasury at 4.1, average 30-year mortgage at 6.1. And so reality is you then have to understand what drives the 10-year Treasury rate to understand what's driving mortgage rates. And it's not the Fed. What drives the 10-year Treasury rate is the market's view of where inflation is going in the future, right? So now we hit this point of quandary, and you start to understand a little bit last year how the Fed could have cut interest rates and mortgage rates go higher. So if the Fed's cutting interest rates, that allows folks to take on more debt and companies to take on more debt and go out and spend it in the economy. Well, what would that naturally do to inflation? That naturally, all else being equal, drives inflation higher. And so the 10-year is dependent upon inflation. So as inflation goes higher, typically the 10-year is going to follow higher. And then the 10-year is the base for mortgage rates. You apply that 2% on top, and you get to mortgage rates. So, Brett, am I crazy to say that all else being equal, and I want to stress all else being equal, that if you reduce interest rates by the Fed, it actually leaves room for upside pressure on mortgage rates, which is the exact opposite of what's being forecast out of Washington, D.C. right now?
Spot on. And their timing right now, which is not something that's 100% in their control. There's something going on globally right now in the bond market that's going to make this even more challenging. But let's take a step back and let's talk about that K-shaped economy again. So that K-shaped economy, the top of the K, right? If we want to, put a name to what it may be, say it's the Mag 7, right? The Mag 7 right now is pedal to the metal, spending like they've never spent before to build out the AI ecosystem that they need. So the top of the K is absolutely firing, all right? The bottom of the K is struggling. So what they're trying to do is turn on growth in the bottom of the K. So if you get both pieces of the K, the top leg of the K, which is firing right now, the Mag 7 spending like they've never spent before, and then you get the bottom of the K now starting to spend as well, and they spend through debt, whereas the top of the K spends through cash. So if the debt financing costs come down and allows the bottom of the K to start spending, now the entire economy is spending, right? So what does that do? Clearly, it's going to drive growth. Clearly, growth is going to drive inflation. So that's exactly what Taylor is pointing out. And then to fuel the challenges that Jerome Powell and his team are facing right now is the Japanese bond market, right? That's where we are. We're way, 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 way overseas right now. The Japanese bond market is coming unglued. It is coming unhinged, right? Japanese economy essentially was stuck in a period of deflation for decades.
Three decades, to be clear.
Yeah, and they manipulated the heck out of their bond market by using quantitative easing, right? So they did what we did about a decade ago, which is they bought a lot of bonds to suppress interest rates there to stimulate their economy. Now they're not buying the bonds anymore, and they actually have about 3% inflation over there, which they were been begging for decades because they had no inflation, They had deflation. So you have the bond market in Japan and actually in the United Kingdom as well. Interest rates are going up materially. What we have to realize is we don't operate in a vacuum, right? We operate on a global landscape. So you have bond yields going higher in Japan and in the UK. If people can get higher bond yields other places, they're going to shop the market. They're going to go get them. So it takes the incremental buyer potentially away from the United States to these other places. Yields go up there. And then people say, well, I'll just buy Japanese bonds, right? That's a decent economy. I can get a higher yield over there, or maybe in the UK, or rates go a little higher in Europe as well. It takes buyers away from the long end of the US yield curve. And it's just a bad time right now to be facing this headwind. But you know what? We got to do it, right? We're TikTok. The market thinks a cut is coming, a 90% chance. And, so that's kind of the way things are shaping up. So it's going to be very interesting, right? And we're going into year end here, and a lot of investors have underperformed their benchmark, typically the S&P 500. So we think it's highly likely we get every dip will get bought going into year end, but we're close to year end being over, and essentially the performance calendar resets on everybody, essentially trying to outperform the S&P 500. And if they want to take some chips off the table, look for that to potentially happen in very early January. This isn't the first time we've seen the calendar drive the decision-making of institutional investors. So I think that leads us perfectly over to dive back to touch on the last bit of the mortgage conversation, Taylor, just with where rates are currently versus maybe where they could be here, depending on what happens with the yield curve.
Yeah. So I think that so the political pressure out of DC is mounting dramatically, and what you're having DC do is stack the deck. And they always do this too. This isn't Trump unique. They're going to stack the deck in the direction of folks that are going to make decisions on their behalf. And it looks increasingly likely that Kevin Hassett, if you look at betting markets right now, Kevin Hassett's a 90% odds-on favorite to be the replacement for Jerome Powell coming up in May when Powell's term runs out. And Trump is going to continue to keep his foot on the gas pedal or on the brake, whichever we want to call it, to have interest rates continue to be suppressed. Trump had one Fed governor that he placed on that said, hey, at the last vote, we should reduce interest rates by a full percent. They typically cut by 0.25%, right? So his vested interest. Trump's a debt guy, right? And he's very comfortable with debt. He's a real estate guy. And so he wants persistently lower interest rates. And as he continues to stack the deck with the cards and the Fed presidents that all vote on interest rates in his direction, the direction's lower with interest rates. And so we need to continue to think about interest rates perpetually moving downwards. And I think that kind of likens back to another point in history. When you talk about real political pressure on Fed chairman in the past, you can look back to the last time we saw really, really, really nasty inflation in this country. And so that was back in the 1970s. So Richard Nixon was the president before he got ousted, and Arthur Burns was from 1970 to 1978. He was the Fed chairman. He was Jerome Powell at the time. And Richard Nixon was crushing Arthur Burns, saying, cut interest rates, cut interest rates, cut interest rates. And eventually Arthur Burns caved. And in 1974, he cut interest rates. Inflation got away from us. And then what happened was inflation ripped higher at the fastest pace we've ever seen, including the more recent time here in 2022. And they had to take Arthur Burns got ousted, let me be clear, and they inserted Paul Volcker as Fed chairman at that point. Paul Volcker had to take interest rates, federal funds rate, to 19%. 19%. Right now, they're at 3.8%, to be clear. They were at 19% in 1981 in order to control inflation. And so I think we really have to be careful out of DC and what we're doing. Get that our economy, oddly speaking, will grow faster if we cut interest rates. There's no doubt about that. And that's why market participants are so excited when they hear, hey, we're likely to cut interest rates. That should drive stocks higher, in all things being equal. But at the end of the day, we have seen the negative outcome of this political pressure play out. The last time it seemed as pertinent and as pressure cooker kind of on the Fed chairman as it is right now.
Yeah. I think one thing that Trump and Scott Bessent have tried to get ahead of was the primary driver of inflation back in the 1970s, which is oil prices. So oil prices, you had a shock in the oil market at that point in time, which drove oil prices through the roof. It was actually the best performing asset class in the 1970s was oil. We don't think that's going to happen again. And I can tell you that essentially Donald Trump and Scott Bessent have been on a road show to grease the skids of oil supply. They've spent a lot of time in the Middle East selling very expensive things like chips and very fancy, I think they're F-35.
Oh, I see what you're doing.
This
is the ultimate sales manager thing where you tell your guy to go out and buy all these cars.
Trump's
so they got to make money.
Yep. So Trump is he and Scott Bessent and their team actually very wisely have been front running enemy number one of inflation, which is oil prices. And that is essentially if they can get folks to buy very expensive chips, right, built by NVIDIA in our chip companies here in the United States, Broadcom, and very expensive fighter jets, they have to essentially sell more oil to be able to afford those things, right? Because the folks in the Middle East actually don't have deep enough pockets to afford what they want to buy from the United States. So that is going to keep supply coming on the market. It's pump oil like crazy, keep prices low. Trump wants that, right? To fight off inflation here stateside. And I would argue the same exact thing with Argentina, where you have them looking to keep supply on board there as well. So they have done a round robin, and obviously in the United States, we're bringing as much supply on market as we ever have on the oil side. That was one of the big drivers of inflation in the 1970s. So we don't think that the left tail risk of, essentially 20% inflation can happen again because the primary driver of it was oil. Oil is in everything, your house, your car, the Tupperware you bring your lunch in every day, like literally everything oil's in. So if we can keep oil prices suppressed, it should keep inflation at a fraction, but it needs to be at a fraction of 20%, right? Geez, like we can't go anywhere near that. And they're doing a decent job with that, right? You got oil hovering around 60, which is stimulus to the economy. So they're trying to thread the needle on, having this economy run hot on the inflation side, but also grow. And if things go wrong, you end up in stagflation. So they're trying to thread the needle on that. Let's hope and pray for everybody's sake that they can. But no, it's definitely interesting to see how they have been out there essentially, pounding the pavement to trying to stay ahead of this inflation thing. Because obviously they're trying to cut back here.
I just want to say nicely done, because I heard this theory from you a while back, and I thought back to our Wall Street days of like the managers being like, hey, you should go out and buy that Porsche. You should go out and buy that watch. You should go out and buy that XYZ, because if you drive up expenses, which is what Brett's getting at for the Middle Eastern folks right now, then you got to make more money and got to go out and sell their product, right? And so they got to sell more oil. So yes, I think Brett's right there that we have been able to suppress oil prices really, really well, and that's well put. And the other side of the coin is just, at the end of the day, I think we have this debt outstanding issue here that we're in $37 trillion of debt. And we've talked about this till we're blue in the face, but really there's only three ways to get out of debt. One is grow your economic backdrop and tax receipts increase. And that's one of the things when you reduce interest rates that hopefully should happen. The economy should grow, tax receipts should increase, and therefore whittle away at that debt. But that's really optimistic to think that's going to do all of the work that needs to be done. The second way is death and despair, and that's defaulting on the debt. And no one on planet Earth wants to see the U.S., the largest economy in the world, most sustained government in the world, default on their debt. I can assure you of that. And the third one is you pay it down with a less valuable currency, and that means inflation, right? So I don't envy the Fed at the end of the day here. The Fed is in a tough situation right now where they've got this labor market that seems to be not terrible, right? It's 4.4% unemployment, but it's kind of the no hire, no fire type market, right? Not that many people are getting laid off right now, although when that happens, it hits the headlines. But really, it's hard to find a job right now. That's the reality of it. And the other side of the equation is inflation is 5 months removed from moving down. It's moved up for 5 straight months, and it's at 3%, which is a really important economic bogey for people because they say 3% and they say that's a full percent off the 2% target. So at the end of the day, I guess our point here is we don't envy the Fed. The Fed is in a tough situation. They get it from all angles. When they cut, people hate them. When they don't cut, people hate them. At the end of the day, they are doing their best. We want to keep them as independent as we can. I do think that DC is starting to infringe upon that a little bit. But who benefits from lower interest rates? The broad economy benefits. The lower shape of the K-shaped economy, whether it be businesses, whether it be individuals with their credit card debt, they benefit. Who does not benefit from this? Those taking out mortgages. I want to be clear that the mortgage rate is not dependent upon the federal funds rate. It's more dependent upon future inflation, and cutting interest rates can actually detrimentally impact future inflation. So thanks so much for listening, guys. Hopefully you got a good education on what goes on with the Federal Reserve, what they look at, why they cut, and how that affects the markets. Quick ask. If you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
The information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.